Welcome back to CMA USA Exam Coach. In this episode, we are continuing with our topic on marginal analysis. In the last episode, we discussed the first two important applications: sell or further process, and accept or reject special order. In this episode, we will cover the remaining three applications of marginal analysis, which are make or buy decisions, keep or drop a segment, and maximizing contribution margin when facing limiting factors. These are very practical decision-making tools used by management to choose the best alternative when resources are limited or when facing cost-benefit trade-offs. So let's get started and go through each one step by step.
Now, let's discuss the third application of marginal analysis, which is the make or buy decision. This situation arises when a company needs to decide whether it is better to produce a product or component internally or to purchase it from an external supplier. To make this decision, the company compares the relevant costs of both options. On one side, we have the external relevant cost, which is usually the purchase price quoted by the supplier, plus any additional costs related to buying, such as shipping or handling fees. On the other side, we consider the internal relevant cost of making the product. This typically includes all avoidable costs, which are costs that the company can save if it stops producing internally. These avoidable costs usually include variable costs, like materials and direct labor, and also any avoidable fixed costs, such as certain factory overheads that can be eliminated. By comparing these relevant costs, management can decide which option is more cost-effective. In other words, if the internal cost to make the item is higher than buying externally, it usually makes sense to buy. Otherwise, producing internally could be better. When we break down the costs for the make or buy decision, we can express them with simple formulas. The cost to make the item internally equals the sum of two parts: variable cost plus avoidable fixed cost. The variable cost includes expenses like raw materials, direct labor, and any costs that change with production volume. The avoidable fixed cost means fixed expenses that the company can eliminate if it stops making the product, such as specific factory rent or maintenance costs tied to that production. On the other hand, the cost to buy the item externally includes purchase price plus any additional costs. The purchase price is the amount charged by the supplier for the item. The additional costs might be shipping fees, handling charges, or any other expenses directly related to purchasing. So, to make the best decision, management compares make equals variable cost plus avoidable fixed cost with buy equals purchase price plus additional cost. Whichever option has the lower total relevant cost is usually the better choice financially. Before we jump into solving questions, let's look at a simple example to understand how management decides between making or buying a product. Suppose there is a product that the company can buy from an outside supplier. The purchase price is $1,000. In addition, transportation or delivery cost is $50. So, the total cost to buy the product from outside is $1,050. Now, if the company decides to produce the same product in its own factory, the costs would be as follows. Raw materials cost $400. Labor cost is $300, and other overhead costs are $400. Adding these up, the total manufacturing cost is $1,100. So, we have two options: buying from outside for $1,050 or making internally for $1,100. Since $1,050 is less than $1,100, buying the product from outside is more cost-effective. Therefore, management would usually decide to purchase the product externally instead of producing it internally. This simple comparison helps companies save money and make better operational decisions. All right, students, let's work through a make or buy decision question together. Imagine a company makes a product that costs several things per unit. There's $200 for direct materials, $150 for direct labor, and $75 for variable manufacturing overhead. On top of that, there is a fixed manufacturing overhead of $2 million. But remember, fixed overhead won't change whether they make the product or not. There is also a variable selling and administration cost of $100 per unit. Now the company has an option. They can buy this product from an outside supplier for $490 per unit. So, which choice should they make? Should they keep making the product internally or buy it from outside? To figure this out, we need to compare the costs that actually change depending on the decision. If they decide to buy instead of making, they will save all the variable manufacturing costs, like materials, labor, and variable overhead, because they won't be producing internally. However, the fixed manufacturing overhead of $2 million will still remain. It can't be avoided. Also, only half of the selling and administration costs will be saved if they outsource. The other half will still be there. So, when we calculate the cost of making the product internally, we add up the direct materials, labor, and variable overhead. That gives us $200 plus $150 plus $75, which is $425 per unit. Since half of the $100 selling and administration cost can be avoided by outsourcing, that means $50 per unit is avoidable and should be included in our calculation. So, adding that $50, the total relevant cost of making the product internally is $475 per unit. On the other hand, buying the product externally costs $490 per unit. Now, looking at these numbers, $475 to make versus $490 to buy, it's clear that making the product internally is cheaper by $15 per unit. Therefore, from a cost perspective, the better decision is to continue making the product inside the company. This example shows how important it is to focus on relevant costs, the costs that actually change because of the decision. Fixed costs that remain the same should not influence the decision, because they will be there no matter what. Now let's move on to the fourth application of marginal analysis, which is the keep or drop segment decision. Sometimes a company has different segments, divisions, or product lines. Management needs to decide whether it's better to keep a particular segment operating or to drop it. To make this decision, we focus only on the relevant revenues and relevant costs directly related to that segment. It's important to understand that common costs, those costs shared by multiple segments, are usually not relevant for this decision because they will continue even if the segment is dropped. So, the company compares the revenues generated by the segment against the costs that can be avoided if the segment is dropped. If the segment's relevant revenues exceed its relevant costs, it makes sense to keep it. But if the relevant costs are higher than the revenues, dropping the segment might be the better financial choice. This kind of analysis helps companies streamline operations and focus on profitable segments while avoiding losses from unprofitable ones. From the table, at a glance, we can see that Branch 2 is making a loss of $40,000. So, someone might quickly assume that the management would decide to close that branch. But no, it's not that simple. A company doesn't just shut down a branch the moment it shows a loss. There are many other important factors that the management will look into before making such a decision. And that's what we're going to discuss here. Let's break it down carefully. The key thing we need to understand is that just because a branch is showing a loss in the income statement, it doesn't always mean it's a bad segment. The numbers we see in the final row are after allocating both avoidable and common fixed costs. But when management evaluates whether to keep or drop a segment, they don't make the decision based on the total accounting loss alone. They look at the contribution margin and focus especially on the avoidable fixed costs, not the common fixed costs. So now let's look at Branch 2 again. It has a contribution margin of $190,000. That means, after covering the variable cost, the branch is still contributing $190,000 towards fixed costs. Now look at its avoidable fixed cost. That's $130,000. These are costs we can actually eliminate if we shut down the branch. So, if we close Branch 2, yes, we'll save that $130,000, but we will also lose the contribution margin of $190,000. Let's think about that. We save $130,000 but lose $190,000. That's not a good deal, right? The net loss from that decision would be $60,000, which means even though the branch is showing a loss of 40,000 on the books. By keeping it, we are actually better off by 60,000 compared to closing it. Why? Because common fixed costs, that 100,000 allocated to each branch, will stay whether we keep the branch or not. It's not going to disappear just because we close the branch. It's a shared cost that the company has to bear anyway, so it's irrelevant for the decision. And that's the most important takeaway here. In marginal analysis, when we are evaluating whether to keep or drop a segment, we only look at the contribution margin and the avoidable fixed cost. Common fixed costs are not considered because they don't change with the decision. So, the final conclusion here is, Branch 2 should not be closed, even though it's showing an accounting loss. It is still making a positive contribution toward covering the fixed costs of the company. Closing it would result in a bigger financial loss in the long run. This is a perfect example of how managerial decisions are based not just on accounting profits, but on relevant cost analysis. And this kind of question is commonly tested in the CMA exam, so make sure you understand the logic behind it, not just the numbers. In conclusion, what really matters is whether the branch is able to cover its own fixed costs and still generate some operating profit. If the contribution margin is enough to absorb all of its avoidable fixed costs and still leave something extra, even if it's a small profit, then we should keep that segment running, because it's helping the company by contributing to the overall fixed expenses. But if a segment cannot even cover its own avoidable fixed costs, meaning it's not generating enough contribution margin to justify its existence, then it becomes a burden. In such a case, keeping that branch would result in a continuous drain on the company's resources. That's when management should seriously consider dropping the segment. So remember, it's not just about the bottom line profit or loss shown in the income statement. It's about whether the branch can stand on its own, cover its variable and avoidable fixed costs, and still support the company. If yes, we keep it. If not, we drop it. Now let's look at the fifth application of marginal analysis, which is maximizing contribution margin per limiting factor. This concept comes into play when a company has more than one product or alternative project, but it faces a limitation on one of its key resources. That limiting resource could be machine hours, labor hours, material supply, or even shelf space in a retail setup. So, the company cannot produce unlimited quantities of everything. It must make a smart decision on how to allocate that limited resource to generate the maximum possible profit. Let me explain it with simple logic. If you have more than one alternative in front of you, say product A and product B, and you're limited by a key factor like available labor hours, then you don't just look at the total contribution margin of each product. Instead, you calculate how much contribution margin you are earning per unit of the limiting factor. For example, if product A gives a contribution margin of 50 per unit but requires 2 labor hours per unit, and product B gives 40 contribution per unit but needs only 1 hour, then product B is actually more efficient. Why? Because it gives 40 contribution per 1 labor hour, while product A gives only 25 per labor hour. So, in this case, even though product A gives a higher contribution per unit, product B is the better choice when labor hours are limited. So the decision here is maximize contribution margin per unit of limiting factor, not just per unit of product. This approach helps the company use its limited resources in the most profitable way. It's not about producing the product with the highest unit profit. It's about earning the most contribution from the resource that's in short supply. And this kind of situation is very common in the real world, especially in manufacturing, project planning, and budgeting. CMA students should be very comfortable with this idea because it connects directly to operational efficiency and strategic decision-making. In the upcoming slide, we'll see a detailed example where we'll calculate contribution margin per limiting factor and decide which product the company should prioritize. Let's discuss and understand with a real example. In the table, at a glance, we can see that product C is giving the highest contribution margin, $3 per unit. So naturally, we might think, let's produce more of product C, and will make more profit. But no, it's not that straightforward. Before jumping to a decision, we have to look at one important factor: the time it takes to manufacture each unit. Product C might give a $3 contribution, but it takes 3 hours to produce one unit. Now, compare that with Product A, which gives a smaller contribution of $2 per unit, but it takes only 1 hour to produce. This is where we need to bring in the concept of the limiting factor. In this case, the limiting factor is time, specifically, the number of available production hours. So instead of just looking at the contribution per unit, we calculate contribution margin per hour. That is, how much contribution each product gives for every 1 hour of the scarce resource. Let's calculate. Product A. Contribution is $2. Time required is 1 hour. 2 divided by 1 equals $2 per hour. Product B. Contribution is $2. Time required is 4 hours. 2 divided by 4 equals $0.5 per hour. Product C. Contribution is $3. Time required is 3 hours. 3 divided by 3 equals $1 per hour. Now we have a clear picture. Product A gives the highest contribution per hour, which is $2. Product C gives only 1, and Product B gives the lowest, just half a dollar per hour. So, when time is the limiting factor, the management should prioritize the product that gives the most profit per hour of production time, not the highest profit per unit. In this case, Product A is the most profitable choice when measured by contribution per unit of the constraint. That's why the company should allocate more production capacity to Product A. This approach ensures that the limited resource, in this case time, is being used in the most profitable way possible. And this is exactly what we mean by maximizing contribution margin per limiting factor. In the exam, you can expect questions where they give you the contribution and the resource usage and ask you to recommend which product to prioritize. So always remember, when there is a constraint, think in terms of contribution per unit of constraint, not just total profit per unit. Now let's take this a bit further and see how we can calculate the total profit based on the time available. Suppose the company has only 50 hours of production time available. That's our limiting factor. Now, we'll look at how much total contribution we can earn if we used all 50 hours to produce each product individually. Let's start with Product A. Product A gives us $2 contribution per hour. So if we dedicate all 50 hours to Product A, we get 50 hours times $2 per hour equals $100 total contribution. Now, what if we use the 50 hours for Product B? Product B gives only $0.5 per hour, so 50 hours times 0.5 equals $25 total contribution. And now for Product C. Product C gives $1 per hour, so 50 hours times 1 equals $50 total contribution. So what do we see here? Product A, $100. Product C, $50. Product B, $25. Even though Product C had the highest contribution per unit earlier, it does not give the highest total profit when time is the limiting factor. That's the power of looking at contribution per hour rather than per unit. So the final conclusion is clear. If we want to maximize profit with 50 available hours, we should produce Product A because it gives us the highest return for every hour we spend. This kind of analysis is very important in decision-making, especially when companies operate under constraints like limited machine hours, labor hours, or materials. Always remember, in such cases, it's not about how much profit per product, but how much profit per limiting factor.
So, before we wind up, let's take a quick look at what we've covered across these 2 episodes on marginal analysis. We started by understanding the concept of marginal analysis, which is all about making decisions based on the additional benefit versus the additional cost of an action. It helps management take smart decisions by focusing only on the relevant data. Then we discussed the different types of costs that are important in marginal analysis. We learned about relevant costs, HAs, which are future costs that change based on the decision. We saw what avoidable costs are. These are the costs we can eliminate if we stop doing something. We explained sunk costs, past costs that are already incurred and should never influence future decisions. And we also touched on opportunity cost, the benefit lost when choosing one alternative over another. After building that foundation, we moved on to the heart of the topic, the applications of marginal analysis. There are 5 key decision areas where this tool is widely used, and we explained each one step by step with examples. Sell or further process, where we decide whether to sell the product as is or process it further. Accept or reject special order, a decision about taking an order at a reduced price if it adds to profit. Make or buy, choosing whether to produce in-house or purchase from outside. Keep or drop a segment, evaluating whether to continue or shut down a branch or product line. Maximizing contribution margin per limiting factor, where we allocate scarce resources to the most profitable alternatives based on contribution per unit of constraint. Each of these decisions requires us to ignore the irrelevant data and focus only on what truly changes, the incremental revenue and incremental cost. So that's a complete wrap-up of our 2-part series on marginal analysis, a powerful decision-making tool for managers and an important topic for your CMA exam. Keep practicing the questions. As we mentioned earlier, the examples we covered here are just to help you understand the concept clearly. Don't worry if these were simple. We designed them that way so the logic is easy to follow. More practice questions with additional details and variations will be included in your support pack. Make sure you go through them, solve them step by step, and understand how the marginal analysis logic applies in each situation. That's the best way to master this topic, not just by watching, but by actually practicing it. All right, that's it for now. See you in the next episode, where we'll move on to a brand new topic and continue building your CMA exam confidence, one concept at a time. Take care and happy learning!